Good day, grade 11 FABM students. Our first lesson in Fundamentals of Accountancy, Business and Management 1 is the Introduction to Accounting. For our learning targets, we will define accounting, and then we will describe the nature of accounting, narrate the history or origin of accounting, define external users and give examples, and define internal users and give examples. So let's start. First, let us define accounting. Accounting is, broadly speaking, a system that helps businesses track events that affect them. This process involves identifying the events that affect a business, recording these events, and communicating the summarized results of all events within a particular period to interested parties. Accounting involves the process of identifying, recording, and communicating financial information to internal and external users. It helps quantify data for easier interpretation. Take note, numbers is the language of business. In order to efficiently manage your business, you need to know numbers. After gathering the data on the performance of the company, these are summarized and used as a guide for future decision making. Accounting is a tool used in achieving all these goals. For us to deeply understand accounting, we should know the accounting process. The starting point of the accounting process is the identification of economic events relevant to a business. To be identified as a relevant economic event, there should be a transfer of things with value. For example, for the purchase of an equipment, cash or money is exchanged for equipment. The cash and the equipment both have value, so it means purchasing that equipment is a relevant economic event. The recording of relevant economic events is the next step in the accounting process. After a company identifies the relevant economic events, it records those events which will serve as the history of its financial activities. Recording events should be done systematically and chronologically for easier tracking and interpretation. Finally, after a lapse of specific period, usually 1 year or quarterly or monthly, companies summarize all the recorded economic events into accounting reports. The most popular accounting reports are the financial statements. So the accounting process is the process of identifying, recording, and communicating financial information to the users of accounting information. Let us now describe the nature of accounting. The basic features of accounting are, first, accounting is a service activity. Why? Because it provides assistance to decision makers by providing them financial reports that will guide them in coming up with sound decisions. If the financial reports state that the company is not doing well, therefore the company must make decisions that will help the company to have a better performance. If the financial reports state that the company is running well, therefore there should be decisions or plans on how to maintain the good performance of the company. Next, accounting is a process. A process refers to the method of performing any specific job step by step, according to the objectives or targets. Accounting is identified as a process as it performs the specific task of collecting, processing, and communicating financial information. In doing so, it follows some definite steps like the collection, recording, classification, summarization, finalization, and reporting of financial data. Accounting is both an art and a discipline. Why? Accounting is the art of recording, classifying, summarizing, and finalizing financial data. The word art refers to the way something is performed. It is behavioral knowledge involving certain creativity and skill to help us attain some specific objectives. So it means accounting requires us to be creative and have these specific skills for us to attain our objectives. Accounting is a systematic method consisting of definite techniques, and its proper application requires skill and expertise. So by nature, accounting is an art, and because it follows certain standards and professional ethics, it is also a discipline. Accounting deals with financial information and transactions. Accounting records financial transactions and data, classify these, and finalize their results given for a specified period as needed by their users. At every stage, from start to finish, accounting deals with financial information and financial information only. It does not deal with non-monetary or non-financial aspects of such information. Lastly, accounting is an information system. Accounting is recognized and characterized as a storehouse of information. As a service function, it collects, processes, and communicates financial information of any entity. This discipline of knowledge has evolved to meet the need for financial information as required by various interested groups. Now, let us narrate the history or origin of accounting. Accounting is as old as civilization itself. It has evolved in response to various social and economic needs of men. Accounting started as a simple recording of repetitive exchanges. The history of accounting is often seen as indistinguishable from the history of finance and business. Following is the evolution of accounting. It started with the cradle of civilization. Around 3600 BC, record-keeping was already common from Mesopotamia, China, and India to Central and South America. The oldest evidence of this practice was the clay tablet of Mesopotamia, which deal with commercial transactions at the time, such as the listing of accounts receivable and accounts payable. Then, we had here the 14th century double-entry bookkeeping. The most important event in accounting history is generally considered to be the dissemination of double-entry bookkeeping by Luca Pacioli, the father of accounting, in 14th century Italy. Pacioli was much revered in his day and was a friend and contemporary of Leonardo da Vinci. The Italians of the 14th to 16th centuries are widely acknowledged as the fathers of modern accounting and were the first to commonly use Arabic numerals rather than Roman for tracking business accounts. Luca Pacioli wrote Summa de Arithmetica, the first book published that contained a detailed chapter on double-entry bookkeeping. Accounting is also involved in the French Revolution on the 1700s. The thorough study of accounting and development of accounting theory began this period. Social upheavals affecting government, finances, laws, customs, and business had greatly influenced the development of accounting. During the Industrial Revolution, mass production and the great importance of fixed assets were given attention during this period. 19th century, the beginnings of modern accounting in Europe and America. The modern formal accounting profession emerged in Scotland in 1854, when Queen Victoria granted a royal charter to the Institute of Accountants in Glasgow, creating the profession of the Chartered Accountant or the CA. In the late 1800s, chartered accountants from Scotland and Britain came to the US to audit British investments. Some of these accountants stayed in the US, setting up accounting practices and becoming the origins of several US accounting firms. The first National US Accounting Society was set up in 1887. The American Association of Public Accountants was the forerunner to the current American Institute of Certified Public Accountants, or the AICPA. In this period, rapid changes in accounting practice and reports were made. Accounting standards to be observed by accounting professionals were promulgated. Notable practices such as mergers, acquisitions, and growth of multinational corporations were developed. A merger is when one company takes over all the operations of another business entity, resulting in the dissolution of another business. Businesses expanded by acquiring other companies. This type of transactions have challenged accounting professionals to develop new standards that will address accounting issues related to these business combinations. Let us now have the present, the development of the modern accounting standards and commerce. The accounting profession in the 20th century developed around state requirements for financial statement audits. Beyond the industry's self-regulation, the government also sets accounting standards through laws and agencies such as the Securities and Exchange Commission. As economies worldwide continued to globalize, accounting regulatory bodies required accounting practitioners to observe international accounting standards. Take note, this is to assure transparency and reliability and to obtain greater confidence in accounting information used by the global investors. Nowadays, investors seek investment opportunities all over the world. To remain competitive, businesses everywhere feel the need to operate globally. The trend now for accounting professionals is to observe one single set of global accounting standards to have greater transparency and comparability of financial data across borders. To summarize the main functions of accounting, it means that accounting is about keeping systematic record of business transactions, protecting properties of business, communicating results to various parties in or connected with the business, and of course, meeting the legal requirements. Let us now answer the question, who uses accounting data or information? There are two broad categories of users of financial information. They are the internal and external users. Internal users of accounting information are those individuals inside the company who plan, organize, and run the business. Take note, these users are directly involved in managing and operating the business. These include marketing managers, production supervisors, finance directors, company officers, and the owners. What information will the internal users need that can be answered by accounting? For the management, they need the income or the earnings for the period, the sales, the available cash, the production cost, and for their decision making, accounting analyze the organization's performance and position and take appropriate measures to improve the company's results, the sufficiency of cash to pay dividends to stockholders, and of course, for the pricing decisions. Why do employees need the data or the information? They need it for the profit for the period, and of course for the salaries paid to the employees. For the decision making, they need to know the job security, if they're going to consider in the employee of the company or look for other employment opportunities. For the owners, investors, or stockholders, they need the profit or income for the period, the resources or assets of the business, liabilities of the business. For the decision making, accounting considerations regarding additional investment, if they're going to expand the business or if they're going to borrow funds to support any expansion plans. Accounting information is presented to internal users usually in the form of management accounts, budgets, forecasts, and financial statements. This information will support whatever of the decision of the internal users. Now let us have the external users. They are the individuals and organizations outside the company who want financial information about the company. These users are not directly involved in managing and operating the business. The two most common types of external users are potential investors and creditors. Potential investors use accounting information to make decisions to buy shares of the company. Creditors, such as the suppliers and the bankers, use accounting information to evaluate the risks of granting credit or lending money. Also included as external users are the government regulatory agencies, such as the SEC, or the Securities and Exchange Commission, the BIR, or the Bureau of Internal Revenue, the DOLE, or the Department of Labor and Employment, the Social Security System, or the SSS, and the LGUs, or the local government units. Let us now discuss the examples of external users one by one. Let's start with the creditors. So we all know that the creditors need to determine the creditworthiness of an organization. Terms of credit are set by creditors according to the assessment of their customers' financial health. Creditors include the supplier as well as the lenders of finance, such as the banks and other lending companies. Next, we have the tax authorities, or the BIR. So they need to determine the credibility of the tax returns filed on behalf of a company. Next, the investors. So they need to analyze the feasibility of investing in a company. They want to make sure that they can earn a reasonable return on their investment before they commit any financial resources to a company. And of course, the customers. They need to assess the financial position of its suppliers, which is necessary for them to maintain a stable source of supply in the long term. The last that we have here is the regulatory authorities, or the SEC and the DOLE. SEC stands for the Securities and Exchange Commission, while the DOLE stands for Department of Labor and Employment. They need to ensure that the company's disclosure of accounting information is following the rules and regulations set to protect the interests of the stakeholders who rely on such information in forming their decisions. Let us now summarize the differences between internal and external users. Take note, internal users of accounting information are those who are involved in planning, organizing, and running the business. They need more detailed information on a timely basis to support their decisions. Examples of these are managers, employees, and the owners. For the external users of accounting information, they are those individuals or organizations outside a company who are interested in its financial information. Examples of these are the potential investors, suppliers, and the government agencies. For the second part of our discussion, we will be dealing with accounting concepts and principles. For our learning targets, first, you're going to explain the varied accounting concepts and principles. Then, you must be able to solve exercises on accounting principles as applied in various cases. Accounting concepts, principles, and assumptions are essential in the practice of accountancy. Financial statements become more comparable and more useful to users if these concepts, principles, and assumptions are followed by businesses. We can look at this as a set of rules that govern the accounting process. For our first accounting concept and principle, we have the business entity principle. In this principle, there is a separation and distinction of transactions between the business enterprise and its owner or investor. For our examples, first we have, if the owner has a barber shop, the cash of the barber shop should be reported separately from personal cash. All transactions of the business will be just in business, while his personal matters will be his only. Next, the owner had a business meeting with a prospective client. The expenses that come with the meeting should be part of the company's expenses. If the owner paid for gas for his personal use, it should not be included as part of the company's expenses. The next principle is the going concern principle. This means that the business is expected to continue indefinitely. When preparing financial statements, you should assume that the entity will continue indefinitely. Another example, Mr. Clark's sushi business is experiencing difficulty, but he is still expecting it to continue. That is why he still updates his books of account. Next principle, the time period principle. The financial statements are usually divided into specific time intervals. The business should report the financial statements appropriately to a specific period. For our examples, Philippine companies are required to report financial statements annually. And then, the salary expenses from January to December 2015 should only be reported in 2015. For our fourth accounting concept and principle, we have the monetary unit principle. In this principle, any amount involved in the business is stated into a single monetary unit. For example, Jollibee should report financial statements in pesos, even if they have a store in the United States. IHOP should report financial statements in dollars, even if they have a branch here in the Philippines. Next, we have the objectivity principle. In this concept, financial statements of an organization must be presented with supporting solid evidence. And the intent behind this principle is to keep the management and the Department of Accounting from making financial statements that are affected by their opinions and biases. For our examples, when the customer paid Jollibee for their order, Jollibee should have a copy of the receipt to represent as evidence. When a company incurred a transportation expense, a voucher should be prepared as evidence. Next, the cost principle. This is an accounting principle wherein accounts should be recorded initially at cost as well as assets as their respective cash amounts at the same time the asset was purchased. For example, when Jollibee buys a cash register, it should record the cash register as its price when they bought it. When a company purchases a laptop, it should be recorded at the price it was purchased. When the owner of a sari-sari store buys a calculator, it should be recorded in the cash register as its price when it was bought. Next, the accrual accounting principle. In this principle, revenue should be recognized when earned, regardless of collection. Same goes with expenses, which are recorded when incurred regardless of payment. But in the cash basis principle, revenue is logged when collected, and expenses should be recorded when paid. A cash basis is not generally an accepted principle today. For our example, when a barber finishes performing his services, he should record it as revenue. When the barber shop receives an electricity bill, it should record it as an expense even if it is unpaid. Our eighth principle is the matching principle. In this principle, cost should be matched with the revenue generated. It requires that the expenses incurred during a period be recorded in the same period in which the related revenues are earned. For our example, when you provide tutorial services to a customer and there is a transportation cost incurred related to that tutorial services, it should be recorded as an expense for that period. Another one, you sold the goods to your customers. The revenue increases and the inventories decreases. Therefore, the reduction of the inventories in relation to revenue is called the cost of goods sold, and it should be recorded in the period in which the revenues were earned. Next, the disclosure principle. All necessary, relevant, and material information should be reported in this principle for transparency. The company should report all relevant information. Second to the last principle, we have the conservatism principle. This is also known as prudence. Assets and income should not be overstated, while liabilities and expenses should not be understated. In case of doubt, expenses should be recorded at a higher amount. Revenue should be recorded at a lower amount. Example, suppose an asset owned by Nico, like inventory, was bought for 20,000 pesos, but can now be bought for 15,000 pesos. Then the company must immediately write down that the value of the asset is 15,000 pesos because of the lower cost in the market. But if the inventory was bought for 20,000 pesos and now has the market value of 25,000 pesos, it must still be shown as 20,000 pesos on the books because the gain is only recorded when the inventory or asset is sold. Next, the materiality principle. This includes all assets that are immaterial to make a difference in the financial statements, which the company should record as an expense. Example, a school purchased an eraser with an estimated useful life of 3 years. Since an eraser is immaterial relative to assets, it should be recorded as an expense. This is the end of our discussion for the lessons today. And let me read this quote. The past is your lesson, the present is your gift, and the future is your motivation. Thank you for watching this video. Good luck and God bless you all.